Hi, this is Randy Finney with Right Side of the Chart, and this is a closing market wrap for Tuesday, May 7th, 2019. We'll dive into the charts here of the broad markets. We're starting to see, volatility continue to expand. I should say, we're starting to see some significant developments in the market for the first time in a long time over the last, really about the last week or so here. Let's start out with this chart. This is one that I shared on, Friday for members. I did a video, the global analysis of the global stock markets, in which I covered the U.S. and the major global markets, and I also touched on this this chart here, which it's actually, I dug it up. I hadn't updated or mentioned this chart going back now for a couple of years. And I have dozens and dozens of charts, if not hundreds of charts on different charting platforms. And so what this shows here, you can see the annotations on there. I call it peak earnings week cycles. So what I did a few years back, and I was tracking it for a while, is I set these cycle lines apart every 3 months or every quarter. Now, what I had to do is adjust this over time. As you can see here, there are 63. This shows the number of cycles right here, 63 periods. And it's a daily chart, so those are 63 trading days, not 63 calendar days. And that's roughly every 3 months apart. You can see here, for example, the year breaks. There's 2015, and would come in just before February there, just before February 2016. So 3 months apart. But what I had to do is shift the lines. And let me show you. Let me enter stock charts clunky annotation mode here. Back then I had the levels at here, let's do this. I had the lines shifted over here. And remember, there's not exactly 63 trading days in a quarter, just like there aren't exactly 30 days in a month. Otherwise, it'd be pretty easy. So over time, these lines are going to shift. And you can see back then, it just had such a, to me, beyond coincidence, such a tight relationship there of what I was looking at are major inflection points here. Let me circle these for you here real quick. Major inflection points that came on peak earnings week. So there it is. You can see, not always, but a lot of times that's where the market had these major inflection points. An inflection point, by that I mean if you have a trend going into peak earnings week, an inflection point obviously is a reversal of that trend. So as you can see, I don't have them all circled, but a lot are there, and it's too much, in my opinion, to be coincidence. Sometimes you had a continuation here. This looks like we had bottomed and we had just come off a big correction, so really no matter what earnings did then, it was already priced in and we continued. But again, major inflection points along the way, and since I hadn't updated it in a couple of years, that's what I had to do, which I'll do again here. Let's enter annotation mode one more time. Save changes, no. There we go, we're back to where we were. All right, let's center that chart. And you can see here it's continues to play out. And again, by the way, last week was peak earnings week. We had the last of the two five FAAMGs, Apple and Alphabet, both reporting, and so that was pretty much the peak of earnings week. Now that was the last of the 5 market-leading FAANG stocks to report, and you can see that is exactly to the button where the market topped back in January. Late January 2018, before a sharp correction. So it only makes sense that you're going to have major inflection points right around peak earnings week. And so far, so good here. This was it again. That line comes right at last week, and you can see, it's since these lines have been shifted to kind of adjust and align with peak earnings week. So far, so good. So just something to note. And again, you're looking for inflection points. So we obviously have a strong trend leading up to this one. And will that result in another, inflection point in the market? We'll see. Just wanted to share it with you guys. Okay, as far as the markets go, we're starting to see the selling accelerate, which is typical after a breakdown or in the early stages of a correction. Markets usually top, peter out a little bit. So let's just talk on really what's happened today, what didn't happen. Okay, so we have recently the breakout in QQQ, which has now clearly failed. I'm talking the breakout to new highs right here. Let me box that in for you. There's the breakout. Again, we had a double top here right around that 187.76 just level, broke out, and now we clearly printed a close below it. So it's a failed breakout. As I have mentioned before, it is not unusual. I'm going to say this. It's not unusual for a security or the markets to break out and then come in, and instead of making a perfect back test, to come back in, slightly undercut it, clears out a lot of stops on longs that took the breakout, sucks in some shorts. So I'm gonna say that there's certainly the potential there. It is not at this point in time my preferred scenario. I'll also throw that out there. It's just something to watch for. So if the markets can recover soon and power back up and then break out above the recent highs, that's going to be bullish there. So as of now, everything else, the bearish case is playing out. The bearish case being a breakdown and a back test of the trend lines off the lows on December 24th, and the selling starting to pick up. We've dropped back below the breakout level, so there's no way to spin this right now as anything but bearish. Again, if the charts are dynamic, and so is my analysis. So if we can snap back up here soon, maybe we come down. These are rough targets. We have an official short trade. We shorted QQQ a few days ago, so I'm not going to go over the exact price targets. These are just rough targets to look at on the Qs. And here, let's look at everything else too. SPY, whereas QQQ had a failed breakout, QQQ isn't really the stock market. The closest thing to the quote-unquote stock market is going to be the broad market, or the S&P 500, and you can see we simply have a double top failure so far. There's the highs in 2018 right around the 294 level. Doesn't matter to me if we went a hair higher or hair lower. When you're looking at an index of such a large scale, that is for all intents and purposes a double top and a failure so far at that. And followed by, we're starting to see impulsive selling. So as you can see, we came down, we hit, this is a support zone I've had on SPY. So we're down sharp today. No surprise that we had a little bounce into the close. I'll get to my near-term outlook here in a second when we get down to the 60-minute charts. But as of now, that can be construed as nothing but bearish, especially taken in conjunction with the everything else in place here, the recent double top, or the divergences, the negative divergences at the highs right here, just like we had divergence here. And remember, things start out slow, you fail at a certain level, selling starts to pick up a little bit, sometimes you'll get a little consolidation. So we'll see. Right now, like I said, just looking at these daily charts, and maybe if there's time I'll touch on the weeklies. I probably should, because that's very important too. I've never taken my eye off the ball on the weekly charts. We just haven't had a lot of significant developments lately, so I haven't really talked on those. And as I've been saying for many weeks now, until tech breaks, the market won't break. And when tech breaks, the market will break. So there it is. Tech broke right here, back tested, and it continues to move impulsively lower. A lot of hot air in the tech stocks, and that hot air is coming out now. One-sided trades go both ways, and they're strong to the upside, and they're equally as strong, if not stronger, once the trend changes, because everybody that was piling in the crowded FAANG stocks and tech stocks, they're all, stops are being hit now. They want out, and when everyone tries to rush for the exit at the same time, you get a pretty impulsive selling. So in just what is that, a few trading sessions here, we're already down about 5% in XLK. And I'm sure that doesn't look too hot on the weekly chart. And there's your trend line there. We're developing, today's only Monday, and we're developing a pretty nice red candle so far after this trend line break off the lows. PPO is starting to roll over pretty quickly. And again, it's still early in the week. We're coming off oversold levels. And yes, the divergence is only extended on this rally, on this marginal pop to new highs in the tech sector there. So there's your diversion or extension of the existing divergences. And this one, again, this paints the longer term picture here, and these divergences should play out for a sizable drop here, not just a minor pullback. Okay, and we had quite a few stick saves to make mention at the close. A stick save is when you have a candlestick that is, security is broken down intraday, but then you get a little ramp at the close to get that candle to close right back on support. So what stands out is IWM. I've talked about some cross currents in IWM lately. This breakout above the 159.41-ish level, that's that previous reaction high, some reaction highs from back here. So we had the breakout on, what is that, Friday, again yesterday, but again doing so with the divergent high, and then we reversed sharply today. So number one, the breakout did fail, and it did so after a divergent high. Now I said we need to watch this trend line right here. Here's the uptrend line off the lows from March 25th there. And so you can see intraday we were well below, just like right here. And this is why you hold off on before getting too heavily long or short of security when you're trading off the daily time frame. You wait and see if you get a solid breakout, whether it's a bullish breakout to the upside or a bearish breakout to the downside. You wait to get a solid candlestick close. So back here last Thursday we had an intraday break, but we rallied and closed right back above the trend line. Today, intraday break, but we closed right on the trend line. So this one will keep everyone guessing until at least tomorrow. We'll see. The divergences are still there and intact, but we need to take out this level with conviction in IWM, and ideally now, like usually, like with most things, you want to see a break below today's lows to really seal the deal. So if you don't want to wait for an intraday close, wait for a day or intraday break below yesterday's close in IWM, as well as SPY and QQQ, and that will most likely do the trick. So there it is. So IWM is precariously perched on the bottom of that wedge type pattern on the uptrend line, and with divergence in place. So it's still anybody's game. Like I like to say, it's a bit of a yogiism, but I always say support is support until unless broken. So that's where we're at on IWM. And then more importantly, I want to go over this, the FAAMG stocks. If you recall in videos in recent weeks going back, when we were still, before we had even broken down on QQQ and XLK, I said I definitely wanted to see those happen, and not just one or the other, but both. So we have breakdowns in QQQ, a breakdown in XLK. Of course, SPY broke down first, and but what we don't have, and this is important, I said this before, there's 5 what I call the FAANG stocks, FAAMG, and those are the 5 largest components of the S&P 500 or of the Nasdaq 100, and also the top components of the SPY as well, or the S&P 500. So let's go over those real quick. We have here, let me load a watch list off screen. First is Apple, and I posted this on the site today, and that's also, I believe it was public content. We have 3 of the 5 FAANG stocks, and not just 3 of the 5, the 3 largest of the 5, and that is Apple, Microsoft, and Amazon. Not only are those the 3 largest FAANG stocks, they are the 3 largest publicly traded companies in the world, and they're the 3 largest components of the S&P 500 as well. Each and every one of them had a stick save today. So I pointed that out earlier today, that they were coming, at the time they were testing the trend lines. Here's Apple, and I'm referring to these trend lines off the December lows right here. So there's Apple. Unlike everything else, most everything else bottomed on the 24th. Apple bottomed here on January 3rd. And you can see nice clean trend line. We parked right on it today. Apple had negative divergence at the highs, and it failed just shy of that 216.41 resistance level. Pointed that out before. We had this topping pattern back here. You can see we grinded around sideways, and when Apple finally broke it for good, gave up the ghost, and that was all she wrote. So, and of course it came, just like now, came with a divergent high that was really the warning sign that we'd get a likely trend change there. And so we had a divergent high right here. It says DH here, but this is the divergent high. Failure right around resistance. And now it's not over yet, because again, this is a stick save. You zoom in real tight, and what happened to Apple? Well, we broke intraday and we closed right on the trend line. So this, if nothing else, tomorrow and going forward, these are the 3 stocks I'm watching. Apple, next one up is Microsoft, And same story, here's Microsoft. Like most other stocks, it bottomed back on December 24th. Very nice clean up trend line and intraday break, and it managed to close back above it. And as well, it closed a little below this 125.96. That's the bottom of a gap right here. So you had gap support, was tested and held right here, tested again and held. Gap support broke. We closed below the gap, but the trend line saved it right now. So those are the levels to watch. And to make it very simple, if you have a hard time replicating these charts, I use log scaling, by the way. You'll get a slightly different layout or rendering if you use arithmetic or linear scaling. So log scaling, but to keep it simple, just look for a break and or a close of today's lows in all these stocks, and the next one being Amazon. So again, I can't impress the importance of this. These are the market leading stocks right here. They have been for many years and they continue to be, and so these all closed right on. You can see there's the lows on the December 24th. Here's your trend line. We've had a couple intraday pops, but again closed above trend. Very overbought, divergence on the PPO. So I think these trend lines break, and they can break as early as tomorrow, or well, we could rally from here. So it's really about the last straw right now. I can see preventing a much deeper correction this week and in the coming days, is if these levels happen to hold. So there it is. They could go in the overnight session. We can gap down below, or we could gap up tomorrow. Anything is possible, but those are the levels that I'm watching very closely. Okay, and we'll wrap this up with the quick look at the futures. This is the NQ, the Nasdaq 100 E-minis. Same story as I've been highlighting a lot. There's the trend line off the lows on December 24th. That has been broken. That was broken recently, and you can see since then we've been stair-stepping lower. And this was interesting. Today we had been highlighting this sort of a megaphone type pattern, broadening wedge pattern right here in the Nasdaq 100 futures, and it's we can see the near-term trend is bearish. The NQ's volatility's expanded. There's been some big swings, big intraday moves, but we've been stair-stepping lower. In my most recent video, I highlighted here 7804 as a resistance, and that resistance capped both the two advanced ascents on NQ, so that's where it failed. Those were objective shorting entries, and then after the failure, I've added another line here about 77.35. That's one to watch. That's a resistance level now. That was pretty decent support before. And so what happened today is, although the trend has been moving lower, longs have been rewarded, or active traders, by stepping in and buying pullbacks to this trend line. But today we shot down below it. So that's interesting to note. Now we had a little, ramp at the end, but again, it was about a 1% or so recovery rally, but the Qs still closed down 2%. And as I said, let's go back to that real quick. That's all that really matters. Don't get tied up in the intraday noise, especially if you're swing trading. Active trading, that's a whole nother thing. And if you're very nimble and adept at day trading, active trading, you probably don't need these videos. This is more swing trading type stuff. And that is, watch these daily candles, and this tells you the story. How did the market close? And so far, again, about a 2% drop today in both the Nasdaq 100 and the SPY, and that builds on the losses and further strengthens the bearish case. So like I said, right now, really just need to see those three big FAANG stocks give way. If they hold and rally off those levels, we'll just have to see how it develops. But let's jump back to that NQ chart and we'll wrap this up. So that's it. Again, there's the levels. Now, I suspect that will come overnight, sometime between now and shortly after the open tomorrow morning, probably within the first 30 minutes or so of trading. Sometime between then, I suspect that we will hit this target here, the 75, 42, 43-ish target, and likely get a reaction there. If something happens and it's more than that, and we slice right on through there without much of a reaction, keep going, then that's going to say things are pretty ugly right now, and we could get a swift move down there to my next target, about 72, 75. But as of now, that's what I'm looking at. We'll take it one step at a time, see if that even happens. If we do bounce back up, I already labeled the resistance levels that may offer objective shorting ops, And ideally right now, to keep the bear case strong, ideally you don't want to see 78.04ish. Call it 78.05, 78.10, somewhere around there. You don't want to see that level taken out. If so, it'll probably lead to a run at the highs, and it could actually really muck up the nice, bearish developments that we've had recently. So we'll take it one step at a time. If we do happen to take out those levels, I'll do an update at the time. As of now, favor more downside in the near term, at least this level, and quite likely more, whether or not we get a reaction here. And again, how that reaction is, if it's just very muted or we blast right on through there, that would be quite bearish. And I'm talking intermediate to longer term bearish. Here's the S&P 500 E-mini futures. There's the same trend line off the lows. Let's zoom in a little bit so you can see the recent reaction. So we have a similar trend line here, like I showed you on NQ, that we've been bouncing along. These are, again, the S&P 500 futures. And so you have also a broadening wedge type pattern, descending broadening wedge, really. And that's it. We've been stair-stepping down, big volatility expansion. That's what's going on here. If this pattern breaks to the upside with conviction, that would be quite bullish. This could be some type of continuation, consolidation pattern that could take us out to new highs. So these are levels to watch. As of now, the near-term trend since the highs is down. That's the definition of a downtrend, of security making lower highs and lower lows. So it's worth pointing out here, these are the futures. There are potential divergences forming right here on the PPO, if I can move that line up. So if we continue higher in the overnight session and we get a bullish crossover in the PPO, that would put in a divergent low on the 60-minute chart of SPY or ES here, and that could set the stage for a rally. NQ, I think we already burned through. Yes, we already burned through the potential divergences here on the PPO, although there are some potential divergences there on the RSI. So these are things to watch again in the overnight session and into tomorrow. Okay, and last but not least, let's not forget the bigger picture here and where we're at. Sometimes it's very easy to lose sight of the forest through the trees. And this is the bigger picture. This is a weekly chart of QQQ. I'm not even running back to the bull market trend line. Let's just look right now at this 2015, the trend line off the mid 2015 lows, very well defined. Rising wedge on the weekly. You don't get those often. When you get those lead to major corrections. That's why I was very bearish and looking for a big drop at the end of last year, and we got it when we had a breakdown in both the Qs and XLK, and that was our all-in signal when tech broke last time, and that was a big drop there. Now you can see if we extend this trend line, see Qs haven't even back tested, but they came very close, but they're still below that trend line, and now they've already broken this trend line off the lows. This is the one I showed you on the daily chart. Let's watch this candle. This is a weekly chart, and all that this kickback rally has done off the lows is as impulsive as it's been. And I spoke to that in the trading room today. I'm going to give you those comments here in a second. But as impulsive as it's been, it's simply just extended the previous divergences. And I'm of the mindset, like a rapidly shrinking minority are, that this is simply nothing more, or may prove to be nothing more than a bear market rally. And if you're saying, Randy, well, you're crazy, the Q's made a new high. QQQ is not a diversified index. It's a very tech-heavy, concentrated portfolio of mostly tech stocks, 100 stocks. The S&P 500 is the broad market, but when you go through, it's not the entire stock market. The entire stock market is made up of small caps, which are still well off their highs, mid caps, MDY, which are still well off their highs, and a lot of other things. And then, as I said, the S&P 500, which is effectively double topped. So if we fail here, we've really gone no higher than where we peaked back in 2018. Again, not counting basis points on an index that's run up hundreds of percent. So that's where we're at. So look, we can't say, we'll only be able to say in hindsight if that's the case, but I just wanted to point out again the bigger picture. Let's not lose sight of that. And finally, let me show you one more thing. Well, that's the there's the trend line off the 2009 low. So this is the entire bull market trend line on S&P 500. Lots of reactions. Ended with that divergent high, breakdown, a kickback rally. So again, if this was a security I was trading on a 15-minute, 30-minute, 60-minute chart, daily chart, that's not unusual to see a security break trend and come in and back test a pattern or a trend line and then move lower. So as of this point in time, that's all it is. Now, that's why it's important to watch this weekly candle, because here it is. We're back testing, and if we have considerable more downside this week, it's going to take this potential bearish engulfing candle and make it even more bearish. Imagine if we close a week something like this. That would be and it would also fit with how a back test would look. You want to see it an impulsive rejection off that line to help confirm, the next sell signal there. So there it is. And again, very important not to kind of lose track of this. And then finally, to wrap it all up, I wanted to just point out one more thing, and this is what I mentioned in the trading room today, that you have to put things into perspective. And I wanted to go to a monthly chart here on the Nasdaq one, or Nasdaq Composite. Okay, if there's one word that I would categorize the bull market off the 2009 lows, as well as the bull market back in the 90s, which still to this point is a great. This one, if we make new highs soon and continue, and all the indexes break out, and it's clear that the bull market's still going, we will soon be at the longest bull market in history. Right now, this was it back here in the 90s, leading up to the dot-com bubble. And so if the one word that I could assign to this market and that one, it's supersize. Just like you go into McDonald's and you tell them to supersize your meal, you get these giant fries, giant big gulp size soda. And with supersized bull markets and trends and rallies, you have much larger counter trend waves. So here's the first kickback rally in the Nasdaq Composite after the top in 2000. Measured it out, it was 41%. The last bear market, it was about 18%. Bear market rally. And I'm talking the first kickback rally. So it only makes sense, and again, this is why you have to put things in perspective. For those, and I'm saying this for those that are having a very hard time swallowing a pill, that a rally as powerful as we've seen off the lows on December 24th could possibly be anything more than the next leg up in a great Super Bowl market. Again, time will either prove me wrong or right whether this is a bear market rally. And at this point, I can't put much more than a 70% chance that it is. And in fact, we'll have to really turn down soon. If we go much higher, then we've made a clear breakout to new highs and all those indexes, and then from there we'll have to just wait. That means the bull market continues. So again, I just wanted to kind of put things in perspective. And this 26.82, you know what? I haven't updated this in a while. I'll measure it for you right now. From the low to the high, that is about 31%. So keep that in mind. And again, compared to 41%. Now let's look at the S&P 500, and it will tell you a very similar thing here. You know what? I didn't measure it out here, but I did earlier on the site. This is the first kickback rally. I'm grabbing these candles. These are monthly candles, so it might not look like much to you, but let me just make certain I have the bottom of that candle. Yes, I do. To the top, my measuring tool pops up to the left at the bottom of that box. 21.71. So a 22% rally here. Let me add that now before I forget. So there it is. The initial kickback rally in that super bear or following the super bull market was 22% in the S&P 500, whereas this time around we went up, in a comparable bull market. If it is a bear market rally, then it was about 26%. So really not far, right on par with what we saw last time around. So and the similarities, again, the divergences, everything else. So I just want to point out that it is possible. Here's the trend line. Let's try to clean that up. And that trend line's a little sloppy. You can play around with it there. So there's our trend line on the monthly back testing as well on the S&P 500. All right, guys, so that's all long-term stuff. These long-term monthly charts, they're going to take a while. I mean, we won't even have the monthly candles for another 3 weeks. So no matter what happens between now and the end of this month isn't really going to matter on the monthly charts. But if you do have, let's just say, 3 weeks from now, and we print the monthly candle, and you see something like this, that's an impulsive rejection off the back test of the trend line, that would help firm up the case, strongly help firm up the case, increase the odds that this was a bear market rally, and that we're going to go down and not only test but probably undercut those lows. Until then, it's still anybody's game. As I said, folks, watch those trend lines on Apple, Alphabet, and Apple, Microsoft, and Amazon, and we'll go from there. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.